Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Friday, January 21st, 5:17 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with the big show, the Friday edition of the Revere Market Insight video, where, well, we're going to do things a little bit differently this week. The 21 over 21, which is a normal feature, is really not applicable in a market environment like this. So we're going to take a look back at what happened the prior week, take a look ahead of next week, and we're going to review some bear market stats from a webinar that I did a while back and then refreshed after the COVID bear market. And suffice to say, this is the type of market that you don't want to be anywhere near, particularly if we go below Friday's close here, and I'll talk about why that is in a minute. So state of the market, correction as of 118. 118 was when we undercut the prior lows in the indexes, so that canceled any rally attempt that we had going. You can see over here at the trend gauge, market leadership, we've been in bearish / downtrend back since January 7th. We haven't owned any individual positions in-house since that first week in January. Short term, bearish again since 1.7. Medium term, bearish since 118, and today the uptrend, which had been in place since July 20th on the 200-day long-term moving average, has moved to neutral as we're having we broke the 200-day moving average in our first weekly close below on the S&P 500 since June of 2020. We'll take a look at that momentarily. So what happened today? Not what you want to see, a close at the weekly lows. No help from growth stocks, but really no help from the indexes either. There still are some defensive pockets holding up okay, but we're not needle in the haystack type of guys here at Revere. So the G6 down 2.9%, S&P 500 down 1.9%, NASDAQ 100 down 2.8%, Dow down 1.3%, mid-caps 1.7%, Russell 2000 1.8%. Let's go to the tail of the tape. But first, let's take a look at the team here at Revere. We've been really putting our strategy to use, our participate in uptrend / get out of the way during downtrend strategy, and it's been mostly getting out of the way so far in January. Our exposure to the market down to less than 15%. And that's using S&P 500 index funds. So if you're interested in an approach that identifies when the market turns from healthy to unhealthy and gets you out of the way, give us a shout. You can email any of us, Dan, Tim, Hunter, Muriel, Alex, or Don at revereasset.com, or call 855-REAL-WEALTH. That's 855-732-5932. So let's get to the tail of the tape, and then simultaneously let's get to what's going on with the indexes, and then we'll talk about some stats from some bear market stats. So as I mentioned, in a correction since 118. So we operate under a certain framework here, and that is what's going on with the market from a macro standpoint and a sentiment standpoint. How does that dictate into the action in the overall market? And we always have a bull case and a bear case. Our bull case, we want to be above the 21 and the 50-day moving average. We decisively broke those last week and this week. So now we're on to the bear case, which was a failed breakout, a break below the prior high of 45.46, and we broke that this week also. So what I was watching for today was the S&P 500 versus the 200-day, and it did an undercut and reverse, but then broke back below again, and that was not how we want to finish. Some news: Netflix earnings not well received, down 22%. No matter how much you like a stock, stocks have times to be in them and times not to be in them. It is not to be in the time, not the time to be in Netflix. So today's action: open week. Let's take a look at the S&P 500. Let's go on a 5-minute chart here. So we opened week with a little bit of a gap down, and then this is where we undercut the 200-day moving average and then rallied up to 44.94, and then very similar to yesterday. Yesterday was a little gap up and a rally, and then we rolled over into the lows of the day. Again, peaked mid-morning, rolled down into the lows of the day. This is bear market action. Let's go back to the daily chart, and what you'll see here is this big, ugly black line, and the fact that we closed underneath it, and that is a big red flag to market participants. Why is that? because every bear market, the last 12 bear markets since 1970, have started with a weekly close 1% or more below the S&P 500 200-day moving average, or on the weekly, the 40-week moving average. Now, a little bit of an asterisk on this one, because if you use the daily, we closed 0.7% below, but if you use the weekly 40-week, we closed 1.1% below. So a little bit of mixed action there, but the point is the same. The market is in a treacherous situation, and what happens from here will dictate the action that we take at Revere. No opinions, going with what the market is telling us. So gap down 0.4%, close 1.9. The G6, I mentioned that, down 2.86%. So today, a weekly broad diversified 60/40 stock and bond portfolio down 0.91%. GROTECTION, our in-house flagship portfolio, down 0.48%. We went from, we put on more hedges. We had a little QLD long yesterday when we bounced off the 200-day moving average, but quickly jettisoned that for a small loss, added to our hedges. So our net exposure is 0.14. As I mentioned, so basically we're 86% in cash with 14% exposure to the S&P 500. So what the action, what was strong today? Bonds, staples barely closed positive, and utilities and real estate barely closed negative. So that's where the strength was. But a lot of people have been putting money into base metals, but XME down 5% today. I mean, really, when we're in a bear market and there's nowhere to hide, don't get cute by trying to find needles in a haystack. We suggest you don't, but as always, you get to make your own decisions. So little by little, these S&P levels, I update these whenever I do a video. They were all green a few weeks ago. They're all red now. We're at 43.98, under the 21 and the 50. Every single level has broken the prior breakout range. The prior all-time high range, we're below the 50-day moving average. The 21-day has now closed below the 50-day moving average. We broke that. We broke the 100-day moving average. We broke our prior all-time high pivot at 45.46. Our prior bounce high of 44.65 from September, we broke that today. We're back into this 42.78 to 4,500 range. Broke back into that yesterday, and we broke below the 200-day moving average today. So this isn't my opinion that we should be getting out of the way. This is the market telling me, Don, get the hell out of the way. And it's based on studies that we've done. Markets act a certain way. Growth stocks act a certain way. They started acting like garbage back in mid-November. We jettisoned all of those over the next couple of weeks. And then the indexes took hold. The S&P 500 and the Dow were the last two holdouts. Here you see the S&P 500. It's closed below the 200-day. Let's go to the Dow Jones Industrial Average. You can see its second close below the 200-day. Let's go to the NASDAQ 100. Second close below the 200-day. Mid caps, which have been holding up for a little while, four closes now below the 200-day. And of course, small caps have really been lagging, and their 200 days all the way up here above 220, making new lows going all the way back to January of the prior year. So just the facts, again, tail of the tape telling us to get out of the way. So why do we want to get out of the way? We want to get out of the way because of studies that we've done in the past, and they dictate our sell strategy. And one of our number one rules, and really any rule that you should ask any investment advisor, is never hold anything that is trending underneath the 200-day moving average. It's really that simple. Since 1960, 22 of the worst 25 days and 83 of the 100 worst days in the S&P 500 have occurred under the 200-day moving average. The overall average monthly return of the S&P 500 is positive at 0.88%, but when you're under the 200-day, the monthly average is minus 2.6%. So the only time to have a sell strategy is never. Anybody that follows us knows us very well. And this stat here, we talked about this in the podcast this week. On average, leading growth stocks fall 72% from their peak. That's just, it was hard to fathom the first time I read it. I thought that can't be right. But when you see this happening to growth stocks in leading time, it's really it's a sight to behold, and that's why we don't ever hold on to story stocks because we like this or we like that. That's just not what we're talking about. So here are some stats. The last 12 bear markets. Why do we pay so much attention to the 200-day moving average? Here are the stats from the last 12 bear markets. You can see going all the way back to from 1968 to 1970, and the average loss in these bear markets, 33.5%. This is from high to low, and it always starts with a weekly close 1% or more below the 200-day moving average. So how far do we normally fall from the high until we break the 200-day moving average? On average, it's about 11.3%. Right now, it was a little over 9%. And then if we get out, what happens to the bottom? The pain avoided is another 23% of pain to the bottom. This is from the top to the low. Okay, 23% below before it bottoms. So this is what we're looking to avoid right here. We've got about a little bit over a 9% drawdown in-house here. The market has drawn down about 8%. We're trying to avoid this additional 23% on average that's avoided once you get that first close below the 200-day moving average. So very clear, the market speaks sometimes and it says get the heck out of the way, and really that's what we're trying to pay some attention to. So if I can summarize this with a couple of bullet points from a lunch and learn that I did in October of 2020, the last 12 bear markets, the market does not get into serious trouble unless the S&P 500 breaks the 200-day moving average. And if you want to avoid big losses, we're going to get out of the way with a close 1% or more below the 200-day moving average. And when are we going to get back in? You can get back in if you just want to be a long-term investor and use a 200-day moving average. Buy back in on a weekly close 1% or more above. And here are the general stats. 12 bear markets, 33.5% from top to bottom, high until we actually hit our sell point, on average 11.3%. The average sell saves 23% of pain until the bottom. And re-entering, normally you re-enter 8.4% below where you got out. So we're going to get rid of this. We're going to save this pain. And this is historical stats. This isn't my opinion. I don't know how this bear market's going to play out. Today could have been the bottom for all I know, and we've got rules to handle that also. But on average, you re-enter when you get that weekly close back above the 200-day moving average. You re-enter 8.4% below where you got out. So people say you can't time the market. People that say that don't know what they're talking about. You're going to hear a lot of people talking about this nonsense if you miss the 10 or 20 best days in the market, about how all your returns are gone. But those returns are piggybacked with the worst days under the 200-day moving average, and it's disingenuous for anybody to say that. And if they do say it, say, okay, now quote me if I missed the 10 worst days, and they'll go humana, and it's just nonsense. Under the 200-day moving average is where the market gets in trouble. That's where we are now, and we feel we've taken the appropriate steps for our clients at Revere to protect their assets. Further move down below the 200-day moving average. As I said, we're kind of like right on the edge there between the plus or minus 1% on a weekly close below, but we're ready to pull the ripcord on the small exposure that we do have left. So that's going to wrap it. As always, love to hear from you. You can email me, don@revereasset.com, or you can call us at 855-REAL-WELL. So this is going to wrap up the week. Not going to look at any individual stocks, but okay, let's look at something that's acting pretty well. Gold, forming a nice little cup and handle in a much longer term structure. Big, long cup and handle going all the way back to August of 2011. This is a huge handle that it's putting in here. This is definitely something that has our attention. So there's your chart, the tremendous growth stock, growth ETF, GLD. I'm kidding, of course, but when that's working, that again should tell you everything you need to know about what's going on in the market. So email don@revereasset.com, phone 855-REAL-WEALTH. Wrapping up the week ending January 21st. This is Don Vandenbord with Just the Facts. Thanks for listening and have a great weekend.